Welcome to the Aussie Resources Conference. My name is Kerry Stevenson. This conference is put on by NWR Communications, so our thanks to them for getting all these fabulous presentations that you're going to hear from today. But I'm pretty excited because today we're going to hear from Karina Bader. She is the Resources Analyst for the Material, Resources and Energy sector for Acorn Capital, based there in Melbourne. Karina, always fantastic to see you. You have a wealth of knowledge. Last time we spoke about the NexGen Resources Fund. So I'm sure we'll cover that today. You've got a presentation you're going to share with us?
Yes, I'll just pull that up for you, Kerry. Thank you, everyone. And thank you, Kerry, for hosting today. Today, I'm going to talk about the NexGen Resources Fund and give you a little bit of an update on where we're at from when we last spoke to NWR, which was back in March earlier this year. This is the disclaimer slide, so please read this through at your leisure. I would like to point out that this is a wholesale-only investors fund. It's not available for retail investors. Just a little bit of background and history around Acorn Capital. It started over 20 years ago by our founder, Barry Fairley, who was a mining executive as well. And he had a very particular view that the emerging companies markets had the opportunity for outsized returns due to the inefficiency and lack of knowledge and understanding in that market. And I think that that still stands strong today. We've got unmatched data and IP over 20 years of investing. Acorn Capital has always had a dedicated resources and energy team. And those resources and energy teams have always had a geological and financial background. So again, I think that strengthens the bench at Acorn Capital when you look to invest in this particular part of the market. Now, when we first started NexGen Resources Fund, it started back in September 2020, so we're just about to click over our 2 years of performing. We thought about, and we still think that there is this clean energy transition underway, and it's becoming even more pressing. And as we started this fund, we felt that there was investor pressure to encourage that transition. We thought there was government pressure, and we could certainly see that there was social pressure. And those three key planks still remain today. In fact, I'd argue they're even stronger today than they were 2 years ago when we started the fund. We've seen the likes of activist investors actually scuttle demergers. We've seen governments write infrastructure acts into being and declare critical minerals, and we've clearly seen the community understand the consequences of climate change with the massive floods and fires that across the globe that we've seen over the last couple of years. But what else has also happened in that time frame is we've seen a lot more of this geopolitical tension occur. Obviously, the very sad situation of Russia invading Ukraine, and it continues to take place today. And then you've also And what this has really highlighted is those critical minerals that we talk about, the lithiums, the rare earths, the nickel, cobalts, graphite commodities, have very long supply chains. And they actually, a lot of those supplies are coming from places like Russia and China. And the Western world has really started to wake up and realise that we need to work towards mitigating some of these risks around this geopolitical tension. And again, that leads to this increased demand as we head into 2030, when these targets have really been put into place to try and mitigate some of these environmental issues and climate change issues. Now at Acorn Capital, we recognise these commodities are actually a lot harder and take a lot longer to get into production than, say, gold or coal or iron ore. And consequently, we really felt that there was this opportunity for investors to get exposure to these commodities, because to achieve the type of demand that's coming for 2030, we need a huge amount of supply to meet the market, and it just isn't there yet. And it takes a lot longer and costs a lot more than originally anticipated. And as we've seen with inflation occur over the last 6 to 12 months, you can already see those capital numbers are growing. Again, that creates a bit of a barrier for new entrants to come into the market. And so existing producers in these commodities are clearly the winners right now. The lithium producers, the rare earth producers, you can see them printing large numbers of free cash in their latest reports. But that obviously also makes the opportunity for new entrants to come into this market. So if you want to be invested in these commodities, where is it that you go to get that exposure? If you look at the left-hand side of this chart, you'll see that the ASX 100 resources stocks are primarily invested in iron ore or bulk commodities, 66%, and only 7% exposure to the battery metals that we've been talking about, these critical minerals. If you look on the right side of this chart, this is the part of the market that the NexGen Resources Fund invests in, and that is outside the ASX 100, but greater than 10 million of market cap. And you can see clearly that there's 34% of those companies by market cap size are exposed to the battery metals. You've also got a strong component of gold and silver. You've got a smattering of other commodities as well, energy, uranium, iron ore, and other commodities to invest in. So we think that this is this part of the market to be invested in, and this is exactly the sector that NexGen Resources Fund invests. In addition, if you look at the tables on the bottom, you can see the number of stocks that you can get exposure to in the ASX 100 are only 22 versus up to 600 stocks outside ASX 100. Now that changes a bit over time, and clearly we've had this downturn in the market in May and June. Last time I presented, that number was over 600 companies invested. So you've seen some of the smaller companies have really dropped out of that 10 million market cap. That's really where the shrinkage in the numbers have come from. But you can clearly see that you've got a number of companies across a range of commodities, and these companies are at different stages, whether they're explorers, developers, or producers. So we can get exposure to commodities across different stages of development. And again, that's one of the key investment themes of NexGen Resources Fund. This is an example of the commodities that we invest in at NexGen Resources Fund. On the left-hand side, you've got since inception in September 2020, the commodity split, and then on the right-hand side is our August 2020 number. The very bottom thick blue line is the gold and silver exposure, which you can see over the majority of the fund life has remained fairly stable. At the very beginning of inception, we had, as we were investing the fund, there was a higher percentage of gold. But if you'll also recall back at that time in September 2020, that's when the gold price was running really hard as well. So you had valuation increase as well as us investing at that time. But since then, we've had in the blues in the middle, that's our battery metals exposure, from lithium to cobalt to graphite, nickel, rare earths, copper. And that's stayed relatively steady throughout the fund over the life of the fund so far. And in the top in the grey, what you'll see there is our energy exposure. And clearly in the last 6 months, you've had a real increase in the oil and gas prices, and that's as a direct consequence of the invasion of Russia into Ukraine and impacting on supplies. I mean, to the point where really the European Union is looking at a very difficult winter coming ahead. So those commodities we believe are likely to stay strong in the short term. And we do have clearly exposure to those funds, those commodities. This is the Lassonde curve. If you've listened to my talk before, I've explained this curve, but I'll go through it again. On the right-hand side, you'll see at the very bottom, you look at explorers with about a $10 million market cap, and on the, sorry, that was the left-hand side, and on the right-hand side, you've got producers roughly with a valuation of about $1 billion. So the y-axis is the value of the company, the x-axis is project development. And Lassonde, who was the founder of Franco-Nevada, he broke this chart into explorers, developers, producers, and traditionally that's how we talk about companies in the resources and energy space. But at Acorn Capital, we've then split that out into 9 further areas of stages of development, and you can see those at the bottom of the chart. And the fund at the end of August, you can see where the stock numbers were by stage of development in terms of number of stocks, and also the weight by market cap of those stages of development. And whilst we have 12 explorers in the portfolio at the moment, clearly the downturn in the market has shrunk their market cap. When I presented this back in March, it would have been more like 20% of the fund in explorers. And obviously it's come down a little bit. And consequently, our expansion stage is up to 66% of funds under management. And that's also a reflection on the size of those companies. They're just bigger market cap companies as they go from construction to commissioning and into production. And we've clearly got a number of stocks, 20 odd stocks exposed to that particular stage of development. And at the end of the month, we had 2% in cash, which allows us to have money to deploy into funds and raisings as companies come back to the market. This is a list of the fund's top 5 holdings in alphabetical order. What I'd really like you to take away here is we've got quite a commodity variety in this list. We've got some oil and gas, and that is also a consequence of the prices going up, specifically on the east coast of Australia, as well as more generally the oil price globally. And then we've got some copper, we've got a graphite producer, and we've got a gold going into production. Now, each of these 5 companies, they're in the expansion stage of development, But we see key catalysts over the next 6 to 12 months, which we think will re-rate these companies over that time frame for the fund. Now we have the performance slide, which is always what everyone wants to look at. I leave it to the end to give you something to look forward to. What we like to show, if you look at the chart at the bottom and the thick blue line, what we're really particularly proud of is sort of the continuous and progressive improvement in performance over time of the fund since inception, above benchmark. But what no one month or no one particular stock has hit it out of the park for us. We've delivered sort of consistent and repeatable performance. Clearly, we suffered that downturn in May, June, along with the rest of the market. And in the micro cap or emerging companies market, we definitely saw a bear market. It was a greater than 20% reduction in that sector. And but we can see already in July and August that it has started to bounce back. If you look at our performance in the table above on the 1 year and since inception per annum, we've had positive absolute return as well as beating the benchmark return. So we've performed over the period of life of this fund very well. Also internally at Acorn Capital, because we have data that goes back over 50 years in this micro cap space, we can demonstrate that if you stay invested at the bottom of these bear markets, you will have a better return over the coming years and months. If you try and take your money out and put it in cash and then come back 3 months later, you will have a significantly lower return than if you'd stayed invested at the bottom. If you wait 6 months, then you virtually have no improvement in return over the long term, instead of if you'd stayed invested at that very bottom at the bear market. It is very scary, but our data demonstrates on every single bear market over the last 50 years, you've got a better return if you stay invested at the bottom. And I think that's one of the key messages I'd probably like to communicate to the audience here. It is difficult, but the market does recover. And if you stay invested, you will actually get a much better return than if you tried to pull your money out. We do this as a day job. It's our profession. We can't always time the market. NexGen is actually not designed to take money out in cash. We always hold only enough cash really so that we can redeploy it into raisings and funding activity of our companies that we're investing in. We have the ability to hold up to 10% cash, but no more than that. So we're not a kind of fund that's going to end up with 50% sitting in cash. We're constantly looking to deploy our investors' money and participate in this market. And so I think that is the end of my presentation, Kerry.
Karina, that was a great present. I love the way you can just bring it all together, and congratulations on the return, by the way. That looks pretty impressive. Do you give dividends from the fund back to investors?
Distributions, obviously it's up to the clients whether they choose to reinvest those distributions, and we did have a distribution in July.
Fantastic. Okay, so I've got some questions because I noticed those top 5 companies that you had. One of the things that have been spoken about in the past is copper. Now, copper since inception, and we talk about going into the EV revolution, if you like.
Yeah, it actually hasn't been a great return for us.
Since the beginning of time we've Well, I guess my question is, what do you think of the future? Because 700 million tonnes have been mined to 2020. We need another 700 million in the next 20 odd years. How the heck is that going to happen?
Sort of going back to my original comment about how long it takes these deposits to actually get into production from discovery. I mean, and then to make a discovery and get it through to production can take over 10 years. And here we are in 2022 looking to have a target by 2030. Absolutely. There is S&P just recently came out with a research report talking about the supply shortage in copper, which will definitely become a deficit by 2025. We've seen the copper price in this bear market drop from about $4.50 to $3.50 a pound. So clearly the market's retracted. And I suspect, I'm not a macroeconomist, but I suspect that that's fundamentally a concern about GDP growth. And if we're heading into a recession because interest rates have been rising globally in response to the inflation numbers, I suspect that will be a short-term response. And in the longer term, you know, over 12 months and beyond, you would start to see that copper price responds back. Because as you said, and if you look at any of the research that S&P have put out, they actually go through and show how much more electric vehicle batteries and cars use of copper versus an internal combustion engine. And
yeah, about 4 times as much. Now, by the way, ladies and gentlemen, while you're on here, if you want to ask Karina, a question, pop it into the Q&A down on the bottom there. You'll see the Q&A bar. Pop a question in. We've got about another 5 minutes, and I'm more than happy for you to get involved, ask the questions. This is the time. If you've got something playing on your mind, maybe you want to ask a question about the oil and gas sector or the lithium sector, which I'm about to ask, but please get involved, ladies and gentlemen. Don't sit back and be a participant, not just a watcher. All right, Karina, since I haven't got any questions there, you mentioned the new energy materials like cobalts, etc. What's the lithium exposure like within the fund?
So we did have quite a high lithium exposure into the second half of last year, and we felt that that was looking fairly strongly valued, and we thought we could see better value elsewhere. And so we basically reduced our lithium exposure over the course of the end of last year, and we increased our rare earth exposure. In the first half of this year, we've sort of seen a little bit of that retraction in the rare earth space as the rare earth commodities have dropped a little, but the lithium prices have stayed strong. The fund is currently increasing our exposure again as we look to new opportunities, and we can see that there are some good projects coming through the pipeline now. A lot of the projects that were strongly supported and valued last year were very early stage projects, and I look at this chart here, they're in the early stage 2 part of the market, and so we're very cautious investing significant amounts of money in those projects. So the way we manage the risk profile when you're an early stage company is we reduce the weight in the portfolio. So it's not turning up in our top 5 yet, but those companies are in the fund and we are exposed, but we weight them smaller because of the risk, the amount of time we believe it's going to take to get into stage 3 and then to FID and then to construction. We just feel the weight in those companies will be lower than a company that's already at, say, at stage 3 or in the expansion stage. We will always weight those companies at a higher level in the fund, and that's reflected also in the weighting, as you can see in this chart, being higher as well.
All right, well, I've got a million questions, but unfortunately the audience has suddenly woken up and asked a lot of questions. First one is, do you invest in coal, any coal companies?
We invest in coking coal, but we do not invest in thermal coal. And clearly in the small resources benchmark, you'll note that Whitehaven and New Hope have done extremely well over the last 6 months, and we're not invested in those. We're invested in coking coal because it participates through the steel industry. It's necessary for the production of steel, and clearly steel is a significant component of industrial production for the society. And so we have participated in coking coal, but we haven't participated in thermal. And if we go back to this chart, you'll see this very top line, if you can see my cursor there, that's the coking coal exposure, which is sort of increased and decreased over time. We had a significant exposure to Stanmore Resources earlier this year when they made their purchase of the BHP assets, but we've also significantly reduced that as well in recent months.
All right, next question. Does Acorn have any investments in tin companies? And if not, why not? Andrew seems to think that you should.
No, we don't currently have an investment in tin. It would fit under our other category, which I believe is this line here. Oops, let's go back. We do look, and we are looking. We felt that there were better returns elsewhere in the rare earth space, and significantly last half of last year we had a particularly strong return in rare earths. We can only invest up to a maximum of 40 stocks, and once you split that along the different commodities, we can't invest in everything, but we do obviously look at everything, and tin is certainly a commodity that we keep an eye on, and I do look at companies constantly in the tin market and would look to invest where I saw there was good value to be made.
I'll get on to IPO sector in a moment, Karina, but another question from James was, how do you sort the wheat from the chaff in the explorers?
That's a very good question.
It is, isn't it?
It is, and I've been doing this for a long time, 13 years now, almost at Acorn Capital, and there's no real rhyme or rule that you can use. I generally work towards a process of where I see a good quality project and good quality management. What I find in the resources and energy sector is when it comes to exploration, management actually significantly matters more, I believe, than in the, once you're in sort of you've got an economic asset and you're looking to produce it. mistakes can be made at that stage, but once you've got an asset in the ground, it will ultimately get produced if it's considered economic. But when it comes to exploration, you're really looking at a very different set of skills, and there is not a lot of those skills out there. It can take a combination of teams as well, and you really want to have good quality projects in what you consider to be good jurisdictions. I would say we do have a lot of turnover. Of those 12 stocks that we invest in the explorer stage, we will hold for a period of time. We usually invest for a particular catalyst. We can see that there's a drilling program coming up. We believe that that drilling program should demonstrate the scalability and the opportunity in that fund. If it doesn't, we will exit and move on. But if we do get supporting data to lead us to conclude that we still see that there's opportunity for more discovery to be made, we will stay. And some of our explorers we've been in for 2 or 3 years. Others we rotate out of on at 6 months or up to 12 months, depending on the data that we see. We do try to take a range as well. We'll have copper explorers, we'll have rare earth explorers, we'll have lithium explorers. So we will have explorers across different commodities as well.
Okay, we've got only about a minute left, and I've got 2 questions I want to ask you as well. But before I do you invest directly into any royalty companies?
No, that's not our business.
Not their gig, Mark. I want to know, Karina, before we finish up, what opportunities do you see in the gold sector? You know me, I'm that gold lady.
I mean, obviously you saw we have Tieto as one of our largest.
I love Tieto.
Sitting there, and that's moving into production, and that's part of the reason of the size and the weight of that particular. It's fully funded. It actually just recently raised money in the last couple of days, additional funds. We do see that the gold sector is undervalued, but it is hard to go in at a strong weight at the moment, given the more global macro environment. So you can see we've still just got over about 23 to 24% of the fund invested in gold, and we will always have a proportion of the fund in gold, predominantly because when we look at the market that we're investing, 28% of the market is a gold company. So we will always have an element of gold. We sort of try to see that as more of our stable part of the market. There's always a lot of companies. It's the largest number of companies in our sector, 179 stocks to choose from. So there's always a good quality projects and companies worth investing in that we see as undervalued versus their peers. So we do always look to invest in gold companies.
Karina Bader, as always, never long enough, but it's always fabulous to have your wealth of knowledge. And if they want to find out more, how do they find out more about the fund?
acorncapital.com.au. Have a look at our website. All our products are on the fund, and if you send the general Acorn email through, that'll get through to us. Kate McDermott is our head of distribution and sales, and she's the person who'll contact you if you have a request.
There you go, ladies and gentlemen. I'm sorry we have run out of time, but Karina Bader, thanks for joining us at the NWR Aussie Resources Conference today.
Thank you, Kerry. Thank you very much for having me, to NWR and yourself. Have a great day.
Cheers.